morning, everyone. On behalf of Spark Capital, I welcome you to the 1Q FY19 earnings call of Karur Vysya Bank. We have with us today the management team of KVB, represented by the MD and CEO, Mr. Seshadri, President and COO, Mr. Natarajan, General Manager and CFO, Mr. Sivarama Prasad, and Company Secretary, Mr. Srinivasa Rao. I now request Mr. Seshadri to take us through the highlights of the quarter gone by, after which we will open the floor for questions. Over to you, sir.
Thank you very much, Vinesh. Thank you very much for hosting the call. Thank you very much, all the folks who've dialed in. Wonderful to be able to speak to you, albeit on the phone. This was an important quarter for us at Karur Vysya Bank. This was a quarter where our transformation process began to gather steam. During this quarter, the product set that we are making available to our customers under the new digital platform increased. We now have 4 products that are live on the digital platform, which is essentially home loans, loan against property, unsecured personal loans, and the renewal of working capital loans. In addition, we introduced enhancements and ad hoc facilities under the working capital loans under the new platform. During this quarter, the entire system made attempts to adjust to the new operating platform that we were introducing within the company. We now have roughly 300 applications a day under the new platform, which is very helpful. We also made very significant progress in the development of additional products under the new platform. We see no delays worthy of mention during this call, and we are proceeding as originally planned, which is something that we are reasonably pleased with. During this quarter, business growth, from an advances point of view, we grew 13%. As I had mentioned in previous calls, our aim was to grow at roughly the market rate, and we believe that 13% is probably a little over. But the idea was that we grow at market, but we would try and grow our spreads, which is something that we continue to focus on. The total, assets plus liabilities grew at roughly 9%. On the liability side, we contained liability growth insofar as term deposits were concerned by ensuring that we were priced at the lower end of the market, and consequently we didn't raise too many deposits by paying for them. We were focusing on current accounts and savings accounts, and I'm happy to report that during the quarter we achieved the hallmark of reaching 30% CASA for the portfolio, which we think is an important milestone as we try and improve the funding profile of the entity. Revenues grew 8% in aggregate, 8% on the net interest income side, and 8% on the other income side. We are particularly pleased with the other income piece, where the core underlying profit streams from both fees and commissions that we charge on banking products and fees and commissions on other products grew very, very strongly, and grew strong enough to ensure that the absence of profits from trading income were largely covered. The expenses continue to be at an elevated level, as I've been mentioning. This is on account of the fact that we had opened a lot of branches over the last year or so. The branch expansion process, I must add, has been put on a hiatus. We are not planning to open significant number of branches at this point in time. But having said that, the branches that were opened during the early parts of 2017 and subsequently, the cost associated therewith is coming through the P&L. So expenses grew approximately 16%. The net result was that the operating profit was largely stagnant, up marginally 2% to 460 crores. And subsequently, we had, on account of the fact that we had roughly 700 crores of incremental forward flows of NPA, offset by, recoveries that are coming in largely on account of NCLT settlements. The net NPA came in at about 540 crores, and on account of the net NPAs, we had to make provisions on the credit side of approximately 420 crores. Given all of that, the earnings after tax came in lower at approximately 40 crores. And whilst the overarching theme of the quarter has been that the underlying business dynamics look good, the adoption of the new technology looks good, the new systems and practices that we've put in place also look good. During the quarter, we put in place a new collection system for our commercial business, which has now seen very good adoption at the branches. We are going live with a new recovery management system that will enable us to target the 3,000 and odd crores of written off stock that we have on our book, not written off, the non-performing stock that we have on our book. And in addition, we made substantial progress on the sales and other aspects of the entity. So having said all of that, this is a quarter of reasonable consolidation and also a quarter wherein we started taking steps towards becoming a bank that is digitally enabled and that addresses the needs of Indians in a manner that they would like those needs to be addressed while keeping the traditional values of the entity alive. As undoubtedly most of you will ask, the NPA levels for the quarter were elevated, but the good news is that we think that our problems associated with the corporate book, which we've spent a lot of time talking about, are now behind us. During the quarter, the total NPA on account of the corporate book was roughly 267 crores, and that includes roughly about 160 crores coming from the watch list. You will recall that there was a watch list of 325 crores. So roughly half of that has flown. I had mentioned in previous calls that half of the watch list was non-funded, and therefore, and some of it was performance guarantees, etc., and it is not entirely clear as to when those would be invoked. Consequently, provisions were not being made at this point in time. So half of that has flown. There was also approximately 200 crores of impact on account of the February 12th circular. So during this quarter, instead of 200, it came in at about 217. And there was also marginal flows to the extent of approximately 60 crores on account of other movement. So from our point of view, we think that the corporate book has played out exactly as we had foretold. We think that the problems that we had forecast are behind us. Our expectation going forward is that the NPA movement on the corporate book would be muted. And our expectation actually on a full year basis is that we should be able to have another incremental NPA of roughly about 275 crores to cover the corporate book. With respect to the commercial book, many of you would have noted that the NPA levels were higher than what you've been accustomed to seeing in the previous quarters. But this is reflective of the trends that we've been noticing over the last 2 or 3 years. So I'll just, when you look back to the year 2017-18, you notice that the total NPA in quarter 1 on the commercial side is roughly equal to the NPA that accrues over the following 3 quarters. And the same story applies in 2016 as well. So the Q1 NPAs are much, much higher than the NPAs that we see in the subsequent quarters. The reasons for that is something that we are still debating. One of the reasons that my team is putting forward is that we do have about 30 or 40% of our branch managers getting transferred, and those transfers are effected during the first quarter, and perhaps that is impacting the ability of the newly transferred branch managers to interact with our commercial customers, and their efficacy of collections is a little impaired during the first quarter. Having said that, that's been the trend, and during the question and answer time, I can provide a little bit more details as to how we see this moving forward from the commercial NPA and what our outlook for commercial NPA is. So at this stage, I'd like to hand you back to Abhinesh so that we can open the floor for further questions.
Sure. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Pranav Gupta from HDFC Securities. Please go ahead.
Hello.
Hi, Pranav. Go ahead, yeah.
Yeah, hi, sir. So while you guys alluded to the reasons behind the slippage in commercial going up, it's shot up significantly, so it could not be attributed only to the rejig in branch managers. If you can provide some more color as to, which sectors these slippages have come from, or any other reasons that you see for this, it will be helpful.
Thanks, Pranav. Basically, there are two broad themes that seem to be running through the elevated levels of slippages on the CBG side. One is the fact that, commodity prices have been under stress. They've been recovering off late, but, agricultural commodities prices have been depressed. And there's a large book that we carry on the commercial side, which is basically lending to agricultural traders. So we are seeing some amount of stress there. Mm-hmm. The other area of stress that we are noticing is where there are importers who have been importing, things like timber and so on and so forth, where earlier they used to rely on LOUs, which are no longer available. To some extent, those cash flow cycles have been impacted, and those areas are areas where we are seeing increased losses on account of their cash flow cycles not being what they used to be in the past. So those entities are now trying to adjust to the new reality and trying to find alternate sources, and also trying to reprice their commodities so that they can now play in the new marketplace where the cost of funding is significantly higher than what it used to be in the past. So that transition is taking a little bit longer than we thought it would. But these are the two broad themes that we can see. I just wanted to spend a little bit more time talking through our own experience on the commercial side. I agree with you that the elevated levels of losses are higher than what we should have seen. And this has surprised us as well. So it's not something that we would say that we are very sanguine about. We noticed this in the beginning of the quarter, and what we did was we quickly put together a new collection system, which is a new system by which we can address all our branch managers. We can raise these accounts that, as soon as they become SMA 0, these pop up on the screen of the branch folks, and we can force the branch people to have the conversation with the customer. And that is driving down our SMA 0, 1, and 2 numbers. Historically, as an entity, we haven't been very aggressive in collecting at early stage, i.e., we haven't really been very aggressive in calling customers when they were in SMA 0. We used to wait till they became SMA 1 or maybe perhaps even later before we would go and aggressively call on these folks. Now that has changed. and that is now driving down our entire stock of SMA 0 and 1 very considerably. So that piece is in place. The second piece, which I think is more relevant, is the fact that in this company, the trend on losses that we've seen historically on the commercial side is that Q1 losses are equal to the other 3 quarters losses. That has been the trend in the last 2 years.
Right.
So if you will notice, we started giving these numbers from the analyst deck of December. In December, we had 59 crores worth of NPA on CBG. In March, we had 1 crore. Okay. In September, the NPA accretion was 34 crores, net NPA accretion. And in April, it was 97 crores. I'm sorry, in June. So the first quarter was 97 crores, which is roughly equal to the next 3 quarters put together. Now, if you were to ask me, why is this strange pattern happening, unfortunately, I don't have a really good answer. We only have suppositions. And the same pattern repeats itself in the prior year. Now, is it absolutely certain that the same pattern will repeat itself this year? I mean, I can't really say that I'm absolutely certain, but, I draw comfort from the fact that this pattern has happened in the past. We've also studied this quite intensely. We've gone back into the portfolio. Unlike the CIG portfolio or the corporate portfolio where, you can look at it name by name, this portfolio has tens of thousands of accounts. You can't look at it name by name. So you have to use a tool which is commonly used on the retail side to see how you expect the portfolio to flow in the next 9 months or so. So we've done the analysis. If we use the flow rates that have happened during the last 3 months, so if you were to take the April, May, June flow rates, then then the situation would indeed be alarming, and the losses would be roughly 700 crores. When I say losses, I mean NPA accretion. Mm-hmm. But if you were to ignore these flow rates, because historically these flow rates have been much higher than the flow rates in the succeeding quarters, if you were to ignore these flow rates, then our model shows that the losses will be roughly 300 crores. So, historically, given the fact that the first quarter has been higher than the prior quarters, we are at this point in time of the view that the succeeding quarters, the NPA numbers would start dropping. Unfortunately, that's the best that I can say at this point in time, because we are doing more intense granular work on interrogating this portfolio. We are trying to slice it and dice it and then do the kind of work that requires to be done to get a better handle on this. But this is what we have at this point in time.
Right. Okay, great. That was a fairly expansive answer. So if I come to my second question, considering that, you had a one-off last quarter in terms of interest income, if you take that out, even otherwise you've seen a drop in NIMs, which is largely due to some drop in yields. So, if you could provide some more color on what you see going forward in terms of SME and retail pricing, and given that those are our focus areas and they'll typically be higher yielding products. So, what is the sense that we get in terms of margins going forward?
It's a very good question, Pranav. And it is an area that we are working on, and we need to make more progress, frankly. So what has happened with us is that we now have 2 modes of originating customers. One is using the new digital tool, and the other is using the older mechanisms of acquiring customers. On the digital tool, the risk-based pricing architecture is now fully in place. So the system decides, basis the customer's profile, basis the customer's cash flow patterns, customers' records with the credit bureaus, etc., what the pricing on the loan should be. Now, as a consequence of the risk-based pricing, today, our highest origination yield product is actually retail, which is a little surprising for us, given the fact that a fair chunk of that product is running at is home loans, which for prime customers is priced at about 8.65. So what we are seeing is a reasonable yield on the retail side, which is not being reflected on the commercial side. And that we think will get addressed when our new systems on the commercial side go live next month. So the first bit of automated decisioning tools and pricing tools on the commercial business will go live in August. Once that happens, we think that the spread on the commercial side will go up. Now, there are two reasons why you're seeing the NIM slide. One is that our stock of non-interest earning assets is growing quite considerably. So if you were to look at it, we have roughly 2,100 crores of net NPA, which is unfunded. We also have security receipts of roughly 400 crores. So you have about 2,500 crores of assets, which are non-interest bearing. And that has grown quite considerably. So if you were to go back, let's say a year or so, that number was much lower. And every quarter, we've been unfortunately adding a very considerable amount. So that is in part responsible for the NIM crunch. The origination yield, we have given up some, both on the corporate side as well as on the CBG side. So on the commercial side, I think we will start picking up the yield as we go forward. On the corporate side, we have consciously focused on better quality assets, so we've given up a little bit of yield. But net, we think that the yield that you're seeing today is something that we should be able to improve going forward. I want to caveat this by saying that we are running a little bit of a basis risk, in the sense that our assets are getting repriced differently from our liabilities. Unfortunately, we do have a large chunk of assets that are annually repriceable, and that is something that we are working on to see how we can ensure that going forward we have assets that are repriceable over shorter durations. Now, so far, the basis risk has not flown into our P&L because we've done a reasonably good job of managing our cost of funding. But going forward, that risk remains. But having said all of this, I believe that we are in a sweet spot. I believe that we can increase our spreads. Like we've increased our spreads on the retail side, we should be able to increase our spreads on the commercial side by putting in place the new tools that we've been devising.
Right. Okay, great. Just one data keeping question. If you can provide the quantum of interest reversals for this quarter and comparable quarters, that will be helpful.
I am unfortunately not carrying it with me now, Pranav.
I'll call you, Pranav.
Okay, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Thanks for the additional disclosures. Just a few questions. First, sir, could you just clarify if there was any recovery from the NCLT cases which was routed via the interest income line this quarter?
Yes, there was.
What was the quantum, sir?
33 crores.
Okay. Sir, adjusted for this, would you agree that margins on an underlying basis were down 10 basis points quarter-on-quarter, since last quarter also we had one-off IT refund, I think. So is that a correct?
You have to adjust both for two things, Dhaval. You have to adjust for this definitely. Yes. You also have to adjust for the fact that the non-interest bearing quantum has grown. So when you adjust both, we still see some dip. It's not that there isn't any, but it is a smaller dip than what you're seeing on the face of it.
Sure. Got it. So the second thing is just on margins again. Could you just quantify what's the average yield that we earn on the commercial book currently, and how has this number trended over the last 5-6 quarters? Just trying to understand, is there any yield pressure in this segment, and if so, what the quantum is?
A majority of our book, we have a book of roughly 15,000 crores.
Right.
The median interest rate on the book is roughly 12%.
Okay.
So we have a bit above it, we have a bit below it. Maybe median is a little lower than 12. I'm just speaking of memory right now. Sure. But it's a high rate book. Are we facing, occasional pressures on pricing? Yes. But those are, the information that we have tends to be anecdotal in the sense that, some customer comes and says, I'll go away to another lender if you don't reduce my rate. The question is, we need to come back to you with details on how many of those loans we actually repriced during the quarter. That information right now is not available with me.
Sure.
We can actually take a look at it, and if we think it's appropriate, we'll try and see whether we should provide it as part of our investor deck. You'll agree that our investor deck now carries much more information.
Absolutely, sir. Absolutely. No, I agree, sir. That if you can put that would be very useful, sir. Yeah. And just last couple of data keeping questions. One, what was the risk-weighted assets for at the end of the quarter? And the other is just wanted to reconcile the standard stress pool that we currently have. So we have 160 to 165 crore of non-fund-based exposure, which is not yet devolved and is standard. And the second is 52 crore restructured book standard, and the 76 crore Y25 exposure. Is that the correct assessment?
Yes.
Okay.
See, Dhaval.
Yeah.
You see, the Pillar 3 is getting uploaded now.
Okay, sir. No problem. I'll take it from there. No problem. And just lastly, what have you quantified the impact of Ind AS if we were to move? Any assessment on that front?
We are working through that, Dhawan.
Okay, fine, sir. Great. Thanks and all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Amit Premchandani from UTI Mutual Fund. Please go ahead.
Good morning, sir. Thanks for the opportunity. Sir, again on the yield front, in your slide in the presentation, slide number 17, yield on advances is 985. If you leave aside the impact of slippages and the non-interest bearing assets, what would be the yield on advances this 985 would correspond to?
Give us a minute. We'll just... would you allow us a few minutes to work that out and come back to you?
Sure, sir.
So we haven't got this readily available. So we'll just come back to you rather than hazard a guess. Give us a few minutes. We can go back to go to the next question and come back to this question later.
Sure. And sir, on the yield on investment front, you see a sharp decline in the yield on investment that you report. It's at 693 now. While if you look at the market rates, they are anywhere between 7.5 to 8. Obviously, there's a lag between the market rates and the yield in your portfolio, given that you have a duration of 4. But can we see a sharp increase in the yield on investment next year?
That would depend upon the maturity profile. I mean, that would depend on how much we can, there are two books here, the HTM and AFS. The AFS book obviously yields much more than the HTM book. On the AFS book, we've been hit during this quarter on account of the fact that the shorter end of the yield curve went up very considerably, and the yield curve became very, very flat. So our view now is to understand our AFS book and to see how to reposition that AFS book. With respect to the held-to-maturity book, to the extent that there is space created in the held-to-maturity book under the SLR regime, we will be putting in new assets there. To that extent, yield will pick up. But I don't see it picking up very dramatically in the next 2 or 3 quarters because, our own ability to trade the held-to-maturity book is very limited.
And sir, in slide 6, you have mentioned the growth rates of various third-party fee income products. If you can just quantify the overall fees you generated out of these life, non-life and mutual fund products, that will help us understand the growth are coming from what base.
It is coming from a reasonably smallish base. I'm happy to tell you on the life insurance side, we've now become one of the larger partners for the entity that we do business with. I hesitate to put the numbers in, but from the next quarter onwards, we will think whether we should put those numbers in and disclose it fully, because I'm not carrying those numbers with me. So we can put it in and give it to you.
And even the aggregate third-party number you don't have right now.
The aggregate third-party number we do have, but we would like to put it into the deck and formally release it if possible. Yeah?
Sure, sir. And finally, sir, lastly from my side, this 216 crore Feb circular impact, this was this quarter impact of on NPLs?
Yes, this was this quarter impact. And
this is part of this 160 crore watch list also, right? There's a large overlap, right?
No, the two were, in the last call I mentioned that we have two issues that we are still dealing with. We had 325 crores of watch list and 200 crores of the Feb circular impact. Mm-hmm. So now I'm saying that all of that has flown through. The watch list is half unused, but that may or may not be used in the near future. The rest, on the corporate side, we believe that the worst is over. It will be business as normal from now on. The NPA levels that we expect are limited, and the issues of the past are behind us. That's the message that I'd like to convey.
So the 267 crore was the overall corporate book slippage. If 160 is coming from watch list and 216 from the February circular, and there is no overlap, and they don't add up too much. They add up too much more.
That's because we had about 180 crores of recoveries.
Oh, so these are not gross slippages, these are net of recoveries.
Yeah.
Oh, so what is the gross slippage in the corporate book?
So you just add those numbers up.
So that is the gross.
Give you that number, hold on. Our gross slippage was 445 crores.
Okay. And sir, what is the likely trajectory of ROAs by the end of the year, and what will drive that?
The biggest driver of ROA, as you can see, the biggest expense line item that we have right now is provisions. Our ROA driver, the immediate driver, is going to be the trajectory of the provisions. There are two types of provisions that we need to take into consideration. One is the provisions that are occasioned by the increase in NPA during the quarter. Now, we believe that starting from this quarter, the NPA levels that we have seen in the last 3 quarters will probably not be repeated. Our NPA numbers will be significantly lower than what we've been experiencing in the last 3 quarters. As a consequence, the provisions that we will require on account of the fresh NPA slippages will be much, much lower. Having said that, we may have to make incremental provisions to ensure that the provision coverage ratio goes up a little bit. So, but we can disclose that separately so that analysts like you have a understanding of what provision has been created on account of what. So, if you were to look at it, if our NPAs drop to roughly, we've been mentioning that our expectation is that the steady state NPA accretion on an annualized basis should be about 150 basis points for this portfolio. And that's what we would like to work towards. Which means that we need roughly 75 basis points of provisions at a 50% kind of coverage ratio immediately. Let's take it as 100 basis points. We need roughly 500 crores worth of provisions on an annualized basis. And our revenue post-provision operating income last year was roughly 1,800 crores. So you can do the rest of the math as to what the implied profitability would be. assuming that we are only providing for incremental NPAs that are taking place. Having said that, we will have, so if you were to only provide for that, the ROAs are actually readily computable, and they would be a reasonable level of ROA. But considering the fact that we continue to have NPA, continue to have provisions that are below what we would like them to be, there may be provisioning requirement on account of historical NPAs. When you bring that into the equation, you may have a slightly lower ROA.
Okay, sir.
Yeah.
That's it from my side. Yeah, sir. Yeah.
Thank you, Amit. Thank you.
Thank you. A reminder to our participants, anyone who wishes to ask a question at this time, they may please press star and 1. We have the next question from the line of Jai Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Good afternoon. Sir, just question on the asset quality. So just to get it reconciled, so we had 325 crores of watch list and 200 crores of RBI circular related impaired assets. So that 200 crores has already been recognized, and there is 325 crores portfolio, of which half was non-funded and half was funded. So that half funded is totally recognized.
Correct.
And the non-funded is still remains.
Correct.
And there is no inflow in this book, of this stress book.
No inflow. In fact, on a gross stress book basis, you can see, we hardly have any restructured assets. The book now is clean. You can go through the presentation.
Yeah. So if I were to take the, whatever is there, so 70 crores plus 50 crores of restructured book, which is there, right? That is only 75 crores plus roughly 50 crores.
Correct.
Now, in one of your slides, you have mentioned, sir, 1.7% of corporate book is in SMA 1 and 2.
Correct.
So that would roughly translate to roughly 250 odd crores.
Yeah, give or take, let's say 275 crores.
Okay, and this would include this 525 and restructuring to some extent?
No, it includes everything, boss. I don't know exactly what the SMA status of the 525 and the restructure is, but it includes everything. This is the SMA 1 and 2 put together.
Correct. Sure. And sir, so that part is understood. On SME slippages, sir, have we taken any RBI dispensation of 180 days? And is that, is that GST related issues is creating some elevated slippages there?
Now, I was talking about this flow model that we created and did the analysis. That takes into account any dispensation. So, whilst we have taken dispensation, the model that I talked about, which basically looks at, tries to predict the future on the basis of the past experience, is indicating that if we were to have flow rates, if we had to have flow rates of the same order of magnitude as the last quarter, okay, our NPA will be 700 crores for the year. That's what the flow rate, it's a tool, it's a model, that's what the number it gives. Now, historically, as I have told you, CBG first quarter NPA, both for the last year, which is 2017-18, and the prior year, 16-17, the first quarter number has been equal to the other 3 quarters put together. Okay. Now, what is causing that is something that we are still debating. We don't have a full answer. So if I ignore the last quarter and use the prior 9 months flow rate and project the NPA forward, I get a number of roughly 300 crores, which is in line with the current NPA that we've shown, right? So now, can we, say with certainty that is what would happen? Obviously not, but there is, in our mind, we think that there is a reasonable, reasonable level of confidence that we will end up with an NPA during the rest of the year, which is closer to 300 than to 700.
Sure. Yeah, and sir, just last 2 questions. One is you have mentioned new branch and individual sales incentive If you can elaborate a little bit, I mean, what does this pertain to?
Okay. Now, this is actually an important innovation, and I'm very thankful to you to have brought this up. So, historically, this is a company that has not really stressed its branch staff from a sales perspective. And we never had individual sales targets, nor did we have individual incentives on account of achieving those sales targets. So I'm very happy to, tell the entire group that we now have a system that I think not many banks will probably have. We, on the basis of who does the loan or the bank account opening or the sale of the insurance product, we are able to recognize the sale, we are able to peg it to the individual who did that activity, and we are able to report it upwards. And since now information is available as to who is doing what in the branches, we have now created a product agnostic incentive structure, i.e., we don't really push the branch to sell one product or the other. We want the branch to meet the customer, understand from the customer what he or she wants, and provide whatever service that the customer needs. Now, the product agnostic service incentive structure is built on the basis that if he were to sell a product which has higher margins for us, he gets a little bit more points. The amount of points is driven both by the amount of margins that we get and also the difficulty in selling the product. For instance, insurance is a more difficult product to sell, so you get a little bit more points so that difficult products are not disincentivized. So a product agnostic incentive structure is in place. Individual incentives are now being paid to employees, and this is something that happened in the prior quarter. Earlier, there was a branch incentive structure, and there was only if the branch met its goals would the branch and all the staff in the branch get an incentive payment. The incentive payment is also capped. Now we have an uncapped incentive payment, subject, of course, to RBI's regulations on how these incentive structures have to be run. So I think it's a very, very important change for us. It gives us the ability to measure productivity from a sales standpoint, individual by individual in the branch. Last quarter, when we introduced it for the first time, out of roughly 5,600 employees that we have in the branch, 5,400 were recognized as people who had participated in the incentive structure or at least had made one sale in the branch. So what we are aiming to do is to build the sales culture within the company. We have to get our people to realize that the role of the branch is one where we act as an advisor to our customers and make our products and services available to them. In the quest to turn our branches into advisory rooms where, loans or investments or insurance is made available, this is the first step. We have to do a whole bunch of other things. We need to start getting our people trained on all these products. We need to start giving them more sales-related skills. We also have to ensure that activities in the branches, which can be actually centralized, are centralized, so that we free up time in the branches, so that our employees can focus on customer-related activities. That is something that we are working on. Thank you.
Sure, sir. And last question, sir. So that explains everything, most of it. And then this, after doing all this digital, and leveraging technology, and sort of this more incentive team and the branches, how do you see your, cost to income shaping up in next 1 to 2 years, either in the form of, let's say, reduced OPEX or maybe, better efficiency? So how should one look at the cost to income ratio? Thank you so much.
No, it's a good question. I think from a cost to income ratio, we have been focusing on that very, very aggressively. We've been highlighting to you that we thought that the cost to income ratios would be going up. That was largely on account of two factors. One was the enhanced branch rollout that we did over the last year or so, and also the fact that we were investing in the new systems and technologies that you just mentioned. We've got now a very large effort to contain costs. So we've gone back to the drawing board and we have renegotiated costs with almost every provider. Net, our expectation is that on an annualized basis, at least on a budgeting cycle standpoint, our expense growth for the year will be lower than our revenue growth. So that's the aim, so that we have positive jaws and something flows through into the bottom line. We are relooking all our branches and seeing, productivity levels at the branches, portfolios at the branches, etc. And as of this moment, we have no intention of rapidly growing out our branch structures. So the focus over the next couple of years is going to be to leverage and get more out of these branches. So there shouldn't be too much cost pressure coming into the business, whereas we should get substantial revenue kickers, which will then help us improve the bottom line. So we don't see the current cost-related numbers deteriorate very dramatically going forward. If anything, they will start improving with perhaps a lag of a couple of quarters.
Sure, sir. Thank you and all the best.
Thank you.
Thank you. The next question is on the line of Rohan Mandora from Equirius Securities. Please go ahead.
Sir, good afternoon. Thanks for the opportunity. Sir, as I understand it correctly, the guidance that what we are mentioning is that from the model, on the large corporate side, we are expecting 700 crores of slippage for the full year. And on the commercial side, it's close to 150 basis point steady state run rate that we expect to reach.
No. On the large corporate side, our problems are, as far as we can see, over.
Okay.
And it has come in exactly as we had planned. Okay? So we had told you that we had a 1,200 crore problem. We accounted for every crore of that rupee. Last quarter, we said that we were down to 325 crores out of that 1,200 crores. Out of that 325, roughly half was funded, other half was unfunded. The funded bits have gone into NPA now. We also said that on account of the February 12th circular, there was another 200 crores or thereabouts that was stressed, which was outside of the 1,200 crores, and that has now flown. Okay? So as far as we are concerned, our corporate book does not have any stress as of this moment, right? And our expectation of NPA on the corporate book is that it will be very, very muted going forward.
Okay.
On the commercial book, we have had high levels of NPA during this quarter, 240 crores to be exact. Right. Now, I want to reiterate this because this is an important point, seems to be following a trend that we have seen in the past. In the year 2017-18, our first quarter NPA was 97 crores. Second quarter was 34 crores. Third quarter was 59 crores. Fourth quarter was 1 crore. So the first quarter is equal to the other 3 quarters put together. The 2016-17 book has the same behavior.
Right.
So what we are saying is, we thereafter, first we looked at this, then we said, okay, let's look at the portfolio and model it as to what can the loss be. So the models can be done on various parameters. One parameter is, if I use the flow rates, it's a portfolio. Portfolios have something called a flow rate. It's like a bucket. How much from bucket 1 moves to, the standard bucket moves to SMA 0, which is bucket 1. From bucket 1, how much moves to SMA 1, and so on and so forth. So using that model, if I use the model of flow, using basis the flow rates that happened in the last quarter, then I get 700 crores of commercial losses. But we think that's not likely to happen. Because historically, we've not had those kind of losses. If I use the prior 9 months, I get roughly 300 crores. That's what I meant. I hope this clarifies.
Sure, sir, sure. And so, on the large corporate side, if based on rating, what percentage of the portfolio would be below BBB rated, and what percentage of portfolio would be in some form of project under implementation where DCC is not achieved?
I'm afraid I don't have that information readily available. Can we provide that to you subsequently?
Sure, sir. And so lastly, in terms of, you alluded to during the conversation that mostly the loans are linked to 1-year MCLR. Would that be a right assessment?
A fair proportion of them are linked to 1 year, yes. So we do have a basis risk built in on that basis, yes.
Sure, sir, sure. Thanks a lot, sir.
Thank you. The next question is on the line of Rakesh Chanjunwala from Rare Enterprises. Please go ahead.
Good afternoon.
Good afternoon, sir.
So now, I know, I forgot the question I want to ask here. Let me pass it. Hello?
Yeah, Rakesh.
Yeah.
Go ahead.
What is the question I want to ask? So pass. Let the next question be asked.
Okay, sir. Thank you.
Okay.
We'll take the next question from the line of Dhaval Gara from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity again. Just a couple of data keeping questions. First, was there any portfolio buyout in the retail or commercial segment that we did during the quarter or last year? Just that. And second was on the NCLT cases which are pending. Could you just give the updated outstanding that we have to the balance cases and accounts and any provisioning shortfall that is there? And the last data keeping question was the security receipts. Is there any provisioning requirement in FY19 that you envisage? Yeah, thanks.
Thank you, Dhaval. We did buy IBPC of approximately 500 crores during the quarter. Other than that, there is nothing else. Okay. And it's mentioned in the investor report.
Yeah.
So, and that's parked under retail. So if you were to X that, the retail growth is a little less robust than what it shows in that document. With respect to NCLT, our total provisioning that we are holding is roughly 66% now, 65.5%. Okay. On the list 1, we are holding roughly 68%. On list 2, we are holding 63%.
Yeah.
So does that answer your question, or you are asking for something else?
Sir, I was just asking what is the outstanding now in list 1 and list 2 for us, and any other cases apart from list 1 and list 2 which are in NCLT. So just the stock of NCLT outstanding for us.
I'll tell you, Dhaval. See, in the list 1, the outstanding is 518 crores. Okay.
Yeah.
And in the list 2, 396. Total 914.
Okay.
For 914, we have around 66% of provision now.
Okay. And anything outside the 2 list, which is also in NCLT?
Outside the list, I think there are some cases, but the corresponding provisions as per the Iraq norms are being done.
And is the amount significant?
No. We don't know.
Part of that commercial book, Dhaval, we can, maybe if this is considered appropriate, we can shove it into the investor deck itself.
Sure, sir. No problem. And just lastly, on security receipts, sir, any provisioning requirement that you envisage in FY19?
I think the security receipts we will need to provide. Currently, we are holding at, the holding value is there on page...
Yeah. I saw that, sir. Yeah.
So we think that we will need roughly 50% of that will over time require provisioning. There is no reason for us to provide it. The NAVs that the ARCs are giving us are high enough for us not to have provisioning, but on a prudential basis, I think we should go ahead and provide. That is the position that we've been taking. So gradually we'll have to...
399 crore outstanding that is there net as of June. You're saying we'll need another 200 crore over a period of time, maybe 2 years or so?
Correct.
Okay. Okay. Fine, sir. Yeah.
So good afternoon, Seshadri. If you could just slip in a question. You talked about, a new incentive structure being introduced into the company. While you talked about the sales happening, etc., but so how are the people taking it in terms of it's a complete transformation in terms of culture? So that's one. And the second, so does this kind of increase your overall cost structure on the staff front, or is it kind of built into the current broad expenses that you have on employees? So is it going to be something incremental cost that we should build in?
Krishna Kumar ji?
Yes, sir.
Yeah.
Mr. Krishna Kumar, I think it's a good question. The answer is very simply that how people are taking it is something that we have to wait and watch. Initially, there hasn't been any strong pushback. Even this incentive structure actually covers all staff, including clerical staff. So we haven't. Initially, there was some pushback from our union, but considering that we've sort of discussed with them, and they haven't really taken a very they've taken a more pragmatic view of this, and they are agreeable to the incentive structure being in place. How people react to it and how they adjust to it is something time will tell. This has now not been in existence for long enough for us to have a conclusive view. But we see on the face of it very, encouraging signs. People are actually taking to this well. We have a minute-to-minute information panel which is available countrywide, so people can see what other people are doing, who is selling what, and so there's an information flow which is creating a sense of competition. It is creating a sense of excitement at the front end. All of this people are taking positively as of now. But, the jury is still out, and we have to figure out how, in the long run, things pan out.
Sure, sir. The cost impact, sir, is it increased?
On the cost side, I don't think this is going to be a very material cost driver. We think that the total cost, at least for this year, will come in lower than the cost that we paid out for a less effective sales structure last year. So there was a sales payment that we were making last year. We think that this year we will be paying about the same amount. So it's not going to be a material driver of our expense base.
Sure, sir. Thanks. Thank you, sir.
Thank you so much.
Thank you, sir.
Thanks, sir.
Thank you. The next question is from the line of Roshan Chutke from ICICI Prudential AMC. Please go ahead.
Yes, Roshan.
Roshan, please go ahead with the question. Your line is unmuted. So it seems there's no response. We'll move to the next question. That is from the line of MB Mahesh from Kotak. Please go ahead.
Good afternoon, sir. Couple of questions from my side. One, on the stock of bad loans that you have, which is about 3,500 crores, 2,500 crores from the corporate loan book, this entire 900 crores will see some form of resolution by this end of this financial year. Is that a fair assumption to make? One. Or are there cases which is still being referred by RBI to be referred to the NCLT process? The second question, even if you remove this 900 odd crores from the NCLT case, you're still left with about 1,600 crores in the corporate loan book, which is about 11% gross NPS on that book. Any broad thought process on how are you looking at addressing that part of the portfolio? And finally, on the repossession that you're doing on, let's say, an SME assets, how has been the recovery rates that you're seeing of late?
Okay. With respect to the NCLT assets, there are, I think, two broad streams. One where the NCLT processes are underway and they're progressing and there are the interested buyers and there's a price that the lenders are finding acceptable. And then there are others where the process is at its infancy. So it's a mix of both. I would think roughly 2/3 of the assets will see some resolution quickly. The others will probably drag on a little bit while the court cases and other such issues sort of play out. With respect to the second question, which is what are we seeing by way of recovery rates on commercial?
No, just finishing off the first part, sorry. This 2,500 minus 900 odd crores, which is about 1,600 crores, which is still left in the corporate loan book NPS. What are you doing on that? Because it's still 11% gross NPA on that book.
So we have to work through on that. We are minority lenders in large consortiums very often. Limited power to force the issue. So to the extent that we can force it, we are. As some of our other problems sort of reduce, the flexibility for us to take alternative approaches will increase. So we are parking this problem for the moment, aside for active follow-up and seeing what we can do from a recovery standpoint. We are not really doing anything else at this point in time. One of the options available is a sale to a ARC, but that the more we examine it, the less attractive it becomes from a financial standpoint, though from an optics standpoint for the balance sheet, etc., for the entity, it's attractive, but financially not particularly rewarding. So we are actively pursuing recovery. We're working with the consortiums as the case may be. And as our health improves, in a sense that our P&L starts improving, our flexibility of dealing with this will improve, and we will slowly start getting this off our balance sheet, because having such a large chunk of unfunded non-performing assets on the book is having a negative impact on the rest of the book. So we are aware of that and we're working through it, Mahesh. Now coming to our next question, which is what are we seeing with respect to recovery on commercial assets? I think it's a good question. Our broad experience is that commercial assets secured by residential or commercial real estate, where when we start taking recovery action, which means that we are actually enforcing collateral, we can broadly break it up into two buckets, where we find collateral reasonably easy to sell and where we find it difficult to sell. Collateral values, where the collateral was originally priced at, let's say, 5 crores or 6 crores, unless that collateral is in large cities like Bombay or Delhi, we find it quite difficult to actually dispose of that collateral. And in those circumstances, getting valuations close to the original value or the value that we had assigned to it at the time of giving the loan it becomes a little difficult. I think it's essentially because of two reasons. One is that perhaps at the time of granting the loan, the situation was different, and the appraisal exercise ended up with a price which was not reflective of a forced sale value. The second problem that we have is the number of buyers for bigger ticket properties in smaller towns and locations is few, and very often when those properties are offered, they are not really forthcoming in buying them. So that's the big issue that we are dealing with. So our own experience is the smaller the ticket, the easier it is for us to get rid of the property close to a value that we had originally assigned to the property. The bigger the ticket, the larger the variance. Therefore, our focus is now on smaller ticket loans and larger numbers of those, which is why the new working capital product on the digital platform will go live next month. And we'll try and aim for the smaller ticket bits, which are a little bit safer, and where also we have a little bit more pricing power.
Sure. Thanks a lot. So just one clarification here. When we speak to City Union Bank and some of the other banks which is based out of South, they had indicated that immediately post demonetization there was a marked decline in the your ability to sell because there were no buyers in the market. But over the last 1 year, there has been some level of improvement. Is that a fair assumption to make, or you're saying that, look, there's not been any change on the underlying environment there?
I think anecdotally, once or twice, people come and tell you, I've been able to sell this. But there's no consistent trend that we are seeing. And when you sort of put numbers against it, how many properties did you have that you had to sell? How many did you actually sell? Those numbers are not stacking up. We are not seeing, for the higher price properties, we are not seeing a very robust marketplace.
That's fair. Thanks a lot for this.
Thank you.
Thank you, Mahesh.
Thank you. The next question is on the line of Marsuni Jhumarwala from ICICI Prudential. Please go ahead.
Yeah, this is Roshan here, sir. Thanks for taking the question. Did you see any GST-related issues in SME slippages this time around?
I don't think we saw any GST-related issues. As I was mentioning, our SME slippages seem to be a little seasonal, and that's what we've seen. I don't think I could attribute this to GST. I mean, the underlying problem is it is true that our slippages are a little elevated compared to the last year first quarter. So maybe it is on account of GST, and I wouldn't sort of, make that assertion because I haven't tested that theory.
Okay. And what percentage of your GNPA in the CB book is greater than 5 crore loans and in tier 2, tier 3 cities?
It's a very specific question.
Roshan.
We can give you the answer, but we don't have it right now.
Roshan, Prasad, yeah. We'll try to work on that, and then we'll give it to you. Okay?
Oh, all right. And finally, did you take any dispensation in the MSME book this time? Sorry, I joined the call late.
No, we addressed that multiple times over. We are not looking at it dispensation or non-dispensation. We were trying to give you an answer on what we thought would be the incremental flows over the next 3 quarters. I don't know if you heard what we had to say. Perhaps we can tell you this offline because I don't want to repeat the same story because yeah.
Sure, no problem. Thank you so much.
Thank you.
Thank you, Roshan. Thank you.
Thank you. The next question is from the line of Praful Kumar from Systematics PMS. Please go ahead.
Hi, sir. Thanks for the opportunity.
Praful, we are unable to hear you, so can you be a bit loud, please?
Yeah, Praful.
How are you, sir? Thank you. Hello?
Thanks. It's okay now. Go ahead, Praful.
Yeah. Sir, can you just talk about the new hires that you have done for the last, say, 3 quarters and, what role are they playing in the organization?
The one big hire we've had is the Chief Risk Officer. Aside for that, we haven't hired at the senior most levels very much. And quite frankly, what we're trying to do is transform this place from the inside with the people who currently exist within the organization. So we've hired some other supplementary staff. We hired people on the operations side. We've hired salespeople. And we are now in the lookout for more people, but we from a hiring standpoint, we've not really hired very large number of people so far.
And in terms of ESOPs for employees, is there a proper existing plan, or you're looking at that as well?
We have an existing plan. Many of our senior people were granted ESOPs. So that plan has been put into operation. We have a commitment from the board that continuing ESOPs will be granted on an annual basis to our senior as well as some other key staff. So as we come through the end of this year, and depending upon performance, fairly substantial ESOPs will be granted to the senior level staff.
Thank you. Yeah. Good luck.
Thank you.
Right, Praful.
Thank you. The next question. The next question is on the line of Aditya Singhania from Enam Holdings. Please go ahead.
Thank you. I wanted to check on deposit growth. You've seen a fairly significant increase in loan-to-deposit ratio over the last 12 months. So what is the comfort level there, and what's your thought on pushing deposit growth higher to match loan growth?
Aditya, it's a very good question. We historically used to be, we used to be a player that offered higher than market interest rates. Today, on occasions, our interest rates are lower than big banks like Bank of Baroda and so on and so forth. So we consciously took the decision not to push deposit growth for the reason that we didn't have comfort that our assets would grow very rapidly, right? For the level of asset growth that we had, which is roughly 13% during the quarter, we had ample liquidity and there was no need for us to push time deposit growth. As the asset growth sort of starts stepping up, at that point in time, we'll have to start, opening up on pricing. I think we have a loyal customer base, and our ability to generate incremental liabilities is not something that we have any reason to doubt. So this was a short-term mechanism of focusing on current account, savings account, try and push the low-cost bits up. We succeeded. We've got to about 30%. We are hoping to end the year at something like 32%. If we get there, we think that it would be an outstanding achievement. And as the asset growth starts perking up, we will start pricing our time deposits appropriately to start getting a larger flow. Right now, our time deposit pricing is driven more by, what is the rollover rates? Are the rollover rates varying? So our pricing now is at a level where rollover rates are higher than what they used to be in the past. So we are ensuring that our loyal time deposit customer base don't go away, but we are not attractive enough to drive in the price-seeking depositors. So, and that will be driven on the basis of asset growth. Aditya, I don't know if that answers your question.
Sure. And just on the fee income growth, last year we were seeing fairly high levels of growth on a year-over-year basis. This is purely fees and commissions. That has seen sort of slow down this year to about 12-13%. So how should we see the trajectory of fees and commissions for this year and perhaps next year as well?
I think it's a very good question. Fees and commissions, we are quite happy with the current growth rate. I think we will step up from where we are right now. The first quarter was, I think, a reasonably challenging quarter for us from where parts of the organization attention was diverted to managing the NPA-related issues. Mm-hmm. I think underlying trends on the fee side are good. Will we go back to the 30% growth rate? Arguably not, but I think that we should aim for about 20% in the early 20s range of growth, and I think that's doable. I think on the third-party products, we have a lot of runway, and while we are starting from a small base, it's not small enough to be insignificant. So today we are on the life insurance side. As I was mentioning earlier, we've now become the single largest, one of the largest. Let me not say single largest because I don't have access to that information, but one of the largest provider of bank assurance to our life insurance partner. And we've come a long way from where we used to be 6 months ago. So I think this line will continue to be buoyant. There are other streams that we can tap. On the Forex side, I think we have a lot of room. We have grown here from, 21%, but on a very low base. I think given the very small share of merchant exports that we have, it gives us the ability to play the price game actually, because the profit impact of market share on the other lenders will be so much more than it is to me that I can sort of afford to be a price competitor in this area. And being a price competitor in this area drives in CASA volumes. So that's an active strategy that we are following. And I think there's a lot of room on that front as well. So net-net, I think non-interest income is something that we are reasonably comfortable. We should be able to push this up in the early 20s, if not in the 30s. There will be some amount of cyclicality because this is not accrual income. This is, you're only eating what you're killing. So to that extent, cyclicality may be there, but long-term trends we think are solid.
All right. Just a sort of data point over here. In the first quarter disclosure, you've shown some 44 crores of sort of other income within the non-interest income line. And that's 22 crores from recoveries or from written-off accounts. What is the balance, 22 crores?
There was 12 crores of PSLC sale.
Okay.
And then there were sundry others. I mean, this sort of, between the two is about 34 crores, right?
And this, this recoveries from written-off as accounts, how do you see the trend here? Is this like a one-off or?
No. On the contrary, we think that there's going to be a reasonable stream on the recovery side on this, because two things we're doing. One is historically we've not had a system to track and monitor and manage the recovery process. So as I've mentioned in this deck, the new recovery system is going live by the end of the month. And once that happens, we will have a reasonable view of where our various recovery actions are and what we need to do where to force recovery actions to be taken. Given that, we think that recovery, streams from a revenue standpoint will only grow. There are certain inherent limitations because this is recovery from written-off. Our written-off stock is approximately, 1,200 crores?
1,240.
Yeah, 1,240 crores. Some of it is, irrecoverable. So there isn't a very large stock. But over time, we'll have to move some of our current, as the provision builds up, we'll have to start moving some of what we are holding as non-performing assets into the written-off stock. At that point in time, that will buoy up the stock from which we can recover. So both of this put together, we think that this number is not a one-off. We should keep getting it going forward.
Right. Thank you.
Okay, Aditya.
Thank you. We'll take the next question. That is from the line of Anuj Sharma from M3 Investments. Please go ahead.
Yes, sir. Thank you for elaborating on the incentive structure. One more understanding. Sir, a large part of our staff would be IBA linked, and which has a relatively high fixed incentive structure. These are not exactly similar incentive structures. How do you rationalize it over a period of time? And are the new recruits having a different incentive structure than the old one?
It's a very good question. Our wage structure is largely IBA. At the highest level, there are people who are not on IBA. But at the junior levels, they're largely IBA. And you make a good point that it is technically feasible for us to get employees at a significantly lower cost at the lower levels when you are non-IBA. That step is something that we are debating with the board. We haven't taken that step yet. So essentially the incentive structure is over and above the IBA comp. Correct. So it is not something that removes the IBA comp, but it is over and above the IBA comp to incent people to be a little bit more innovative, a little bit more salesy. But the transition from IBA to non-IBA is something that we have been debating. It is something that we have been talking to consultants about. It is something we haven't taken a decision yet. So that is before the board during this quarter, actually.
And secondly, just, you highlighted that being becoming aggressive on collections and introducing new processes. Does that in any way, risk some of your traditional customers especially in the commercial banking, who has been, used to a lax collection method and maybe enjoyed relaxed. Do you see some risks over there? Is there a trade-off?
You're absolutely right. There is definitely a trade-off. Is there a risk that will piss off a few customers? Most definitely. But unfortunately, I don't think we are in a position where we can afford not to, especially now with this with Ind AS or IFRS 9 coming in. We can't really afford to have people who are not paying us on due date. So we need to do this carefully. We need to ensure that we don't overdo this. If a customer is a good customer and habitually pays us on the 29th day, then perhaps we have to find the wisdom to only go to them near the 27th or the 28th day. Those tools are not available with us as yet. We are in the process of setting up our analytics unit, so that from a collection standpoint, we can fine-tune whom we call and when, so that some of this irritation can be avoided. But having said that, given the situation that we've just come out of, which is very elevated levels of NPA over the last 3 quarters, the decision from the management standpoint was that we will use a one-size-fits-all kind of rule and go and politely talk to all our customers. So we have taken the risk of alienating perhaps some of our customers, but we think that they will stick with us because we've stuck with them for tens of years. So I don't think that will be, that will be a deal breaker.
And sir, lastly, bankers seem to see a lot of growth in the retail segment. Where do you see credit risk being mispriced systematically in retail especially?
Retail, I think that is a very, very broad question as to where are the credit risks being mispriced. I think in every credit cycle, credit risk is mispriced by definition. One needs to look at through cycle profitability. But that is a luxury that very few entities have because you are very often a price taker and not a price setter. So I am of the view that in many of our asset products, risk is mispriced. That is why we are playing on the retail side in the semi-urban and rural areas and generating more of our business from those areas, and where we are able to get a little bit higher price. And we think that as a consequence, perhaps our pricing is a little closer to where it should be. So as I was saying, our retail yield is now higher than our origination yield is higher than our commercial origination yield because we put risk-based pricing structures on the retail side. We need to do the same thing on the commercial side. So we are addressing that in that fashion. But your question is quite academic, and we can perhaps have a longer chat when we meet.
All right, sir. Thank you. Thank you.
Thank you. Ladies and gentlemen, due to time constraints, that was our last question. I now hand the conference over to Mr. Abhinesh Vijayaraj for closing comments. Thank you, and over to you, sir.
Thank you, Aman.